On February 16, 2024, a supplemental report on interest expenses quietly appeared on the U.S. Treasury's public data system. It looked like a routine document posted out of habit, with no prominent headline and little reason for the market to pay attention. But buried in what seemed like familiar pages of numbers was a detail, powerful enough to change the color of the entire global financial system. The U.S. government's total interest payments over the previous 12 months had surpassed $2.2 trillion. I consider that the moment the market should have flinched. Because that figure reaches directly into your borrowing costs, the value of your assets, and the safety of the savings you believe are stable. And if you want to understand why the United States is entering its most fragile period since the 2008 financial crisis, everything starts with this seemingly quiet number. For decades, U.S. Treasury securities were regarded as the most reliable cushion beneath the entire global financial structure. Banks relied on them to anchor liquidity. Pension funds relied on them to balance long-term cash flows. Central banks held them as a core reserve asset. That trust ran so deep that few ever questioned what would happen if this cushion began thinning out. And more importantly, whether the United States still has any room left to fall without triggering shocks across the system. To understand where the fault line lies, we need to examine the structure of power treasuries have exercised for nearly 80 years. After World War II, as the U.S. dollar became the center of global trade, U.S. government bonds became the destination for the world's savings. Export-heavy nations like Japan, Germany, and China reinvested their dollar surpluses into treasuries. This allowed America to borrow at extraordinarily low costs. In 2015, the 10-year Treasury yield hovered around 2%. By 2020, it had moments when it fell below 0.6%. With such low funding costs, the U.S. government could expand its budget, launch stimulus programs, and refinance its debt without significant strain. But this model only worked as long as three conditions held: low interest rates, low inflation, and steady demand for U.S. bonds. All three pillars began to fracture between 2021 and 2023, when U.S. inflation surged above 7% in 2021, the highest level since 1982. The Federal Reserve was forced into the fastest rate hiking cycle in 40 years. The 10-year yield climbed from 1.5% to above 4.5% by late 2023. That jump may have looked like a normal market reaction, but in truth it was a structural turning point. Because treasuries are not just financial instruments. They form the valuation foundation for nearly all global assets. When yields rise, everything must be repriced. Real estate, equities, gold, corporate credit, all of it. Imagine you bought a house in 2021 with a 3% mortgage. When new mortgage rates hit 7%, the value of your home changes not because you sell it, but because the market shifts its understanding of risk. Companies face the same squeeze. Higher borrowing costs eliminate entire categories of investment. Households feel it as well. U.S. credit card interest rates surpassed 20% in 2023, the highest on record. But the most dangerous stress point is not the consumer. It is the U.S. government itself. Each year, America must refinance trillions of dollars of maturing debt. When interest rates double or triple compared to the original issuance, the cost of refinancing increases accordingly. That is how the interest expense balloon swelled, and why 2024 produced a number that should alarm policymakers worldwide: $2.2 trillion in annual interest payments. For context, in 2010 the figure was roughly $413 billion. In 2020, around $522 billion. 4 years later, it had more than quadrupled. What makes this speed dangerous? Because interest costs now consume the budget before Congress even begins allocating funds. U.S. interest payments have already surpassed total national defense spending in 2023, about $858 billion. America is now paying more to service past decisions than to protect itself. In such a landscape, treasuries no longer function as a cushion. They begin to resemble a revolving debt machine with rising maintenance costs. Another shift deepens this fragility: changes in foreign demand. In 2023, China reduced its treasury holdings to about $769 billion, the lowest in nearly 15 years. Japan, still the largest foreign holder, has also slowed purchases due to pressures in its domestic bond market. When these major buyers adjust their positions, the U.S. loses its most dependable clients. The Treasury must offer higher yields to attract new buyers, which, of course, increases the very interest burden driving the problem. This thinning cushion becomes even clearer when we study long-term bond auctions. In 2023, certain 30-year auctions displayed unusually weak demand, forcing yields higher than initial expectations. Moments like these were rare in earlier decades because long-term treasuries represented stability. When investors hesitate at the longest maturities, it is no longer a technical signal, it is an erosion of confidence. History offers examples of how quickly such shifts can escalate. In 1994, the bond market endured a shock when the Federal Reserve raised rates more aggressively than expected. More than $1 trillion in global bond value evaporated within months. Then came 2011. When the United States suffered its first-ever credit rating downgrade by S&P, yields spiked, equities tumbled, and the market instinctively pulled back. But in both cases, U.S. interest expenses were far lower than they are today. The 2024 environment is different. Every move in yields now presses directly on an already swollen interest expense structure. For households, the consequences are visible everywhere. Elevated government borrowing costs make it difficult for market rates to fall meaningfully. 30-year mortgage rates in the U.S. have hovered above 7% for months, effectively locking young buyers out of the housing market. Small businesses suffer as well. They borrow at higher rates, operate with thinner margins, and reduce hiring. From a macro perspective, the United States is entering a phase where each fiscal decision carries a cost amplified by higher interest payments. But from a personal perspective, you experience this shift through monthly bills that quietly rise, and through the unsettling realization that the system you once assumed would cushion financial shocks may no longer be able to do so. What's alarming is not simply that America owes $2.2 trillion in annual interest. What's alarming is that the buffer meant to absorb shocks is disappearing. When U.S. Treasuries, the world's benchmark of safety, begin transmitting risk instead of reducing it, the system enters a state where even a mild tremor can change everything. And this is only the surface. Behind that number lies something larger. Capital flows are shifting, the structure of buyers is evolving, and yields are searching for a new equilibrium, one that is higher, costlier, and far more dangerous. The real question is no longer whether the cushion is thinning, but how much more strain it can bear before the United States is forced to make choices it has avoided for decades. The first real signs appeared before anyone was willing to say them out loud. In late 2023, the Treasury Borrowing Advisory Committee released a short note suggesting that the U.S. might need to revisit the balance between short and long-term issuances. It sounded technical, harmless, almost bureaucratic. But to anyone who has studied sovereign debt cycles, the subtext was unmistakable. The United States was preparing to shift its debt structure, not because it wanted to, but because it had run out of comfortable options. When a government quietly shortens the duration of its debt, it is not optimizing, it is buying time. One of the clearest signals emerged when the average maturity of outstanding Treasury debt began drifting downward after years of stability. From roughly 6.2 years in 2021, projections in 2024 suggested a gradual slide toward a shorter profile. A country that once prided itself on issuing deep, liquid 30-year and even 20-year maturities was now relying more on one-year bills and two-year notes to avoid locking in high interest costs for decades. It was a subtle technical pivot, but it revealed everything. Because a government does not shorten its maturity profile when it feels safe. It does so when locking in long-term costs becomes too painful to tolerate. This is the quiet beginning of the systemic tension, and tension always seeks a release point. By early 2024, bond traders began watching the 10-year yield with a nervous attention normally reserved for recession indicators. Whenever the yield drifted above 4.8%, mortgage spreads widened. When it touched 5%, commercial real estate valuations shuddered. At 5.2%, banks with large portfolios of low-yield treasuries saw mark-to-market losses swell. And at 5.5%, a level not seen since 2001, the entire pricing framework of the U.S. economy threatened to flip into a new regime. The fragility was visible in the banking system long before the headlines caught up. In 2023, Silicon Valley Bank's collapse showed how unrealized losses on Treasury and agency bonds could instantly become existential. But the broader problem didn't disappear after that weekend. FDIC data revealed that U.S. banks held more than $600 billion in unrealized losses on securities at the end of 2023. The number hardly improved in early 2024 because rising yields kept pressure on the very assets once thought to be bulletproof. This is how a cushion turns into a conduit for risk. The moment of system stress does not arrive with fireworks. It arrives when the government, the central bank, and the banking sector all begin reacting to each other's constraints. When the Treasury issues more short-term bills to avoid high long-term rates, the rollover pressure shifts upward. When the Federal Reserve keeps policy rates elevated to curb inflation, the Treasury must refinance at higher levels. When banks absorb these bonds at a loss, they tighten credit. When credit tightens, the economy slows, reducing tax revenue, forcing the government to borrow even more. A feedback loop disguised as routine policymaking. The United States has been here in smaller forms before. In 1979, a temporary technical default occurred when the Treasury failed to process Treasury bill payments on time due to an operational glitch. Yields spiked briefly, investors demanded compensation, and confidence dipped. In 1995 and 1996, the government shutdown raised fears of payment delays again. In 2011, the credit downgrade from S&P triggered a surge in yields and a flight into shorter maturities. In each case, the system absorbed the shock because America's fiscal room was much larger, and global demand for treasuries was unquestioned. Today the conditions are different. The fiscal space is narrower. The interest burden is heavier, and global buyers are no longer guaranteed. The potential breaking point isn't a single event. It is the intersection of several rising curves. Yields moving higher, issuance increasing, foreign demand softening, and domestic banks unable to take much more duration risk. The strain accumulates until a single auction, a single rating review, or a single inflation surprise triggers the repricing everyone has been trying to avoid. When that happens, the dominoes fall in predictable order. The Treasury is forced to offer even higher yields, raising its interest bill further. Banks tighten lending to preserve capital. Corporations pause investment. Housing affordability drops to levels unseen since the early 1980s. Consumers face rising costs on everything from car loans to credit cards. The dollar strengthens temporarily as global markets panic, making U.S. exports less competitive. Tax revenue weakens as growth slows, widening the deficit again. This is not collapse. This is erosion fast, silent, mathematical. And as always, some players lose more than others. Small businesses become involuntary victims. Their borrowing costs rise fastest, their margins compress first, and their hiring plans evaporate. Households with adjustable-rate mortgages or heavy credit card balances face the full weight of higher rates. State and local governments, many of which rely on bond financing for infrastructure, find their costs rising just as residents need more support. But there are winners too. Money market funds thrive when short-term rates stay elevated, pulling trillions into their products. Hedge funds specializing in Treasury market volatility book profits during every spike in yields. High-income households with large cash holdings enjoy improved returns on safe instruments. And firms positioned in energy, commodities, or defense often benefit from the inflationary and geopolitical environment that accompanies fiscal stress. This is how financial rebalancing works. Not by destroying value evenly, but by redistributing it. The timeline ahead is not a mystery. It follows patterns observed in every country that has ever faced a rising interest expense spiral. In the next 24 months, interest payments will continue to pressure the federal budget. Legislators will debate cuts, but most reductions will be politically constrained. The Treasury will issue more short-term debt to contain long-term costs, deepening rollover exposure. Mortgage rates may fluctuate, but meaningful drops will be difficult while yields remain elevated. Between 2026 and 2028, the maturity wall becomes unavoidable. Debt issued in the low-rate era of the 2010s will have rolled over into the high-rate era. The United States will face a fiscal environment where interest consumes a larger share of revenue than at any time in modern history. Policymakers may attempt targeted tax increases or selective spending freezes. Some form of structural adjustment, however small, becomes nearly inevitable. By 2030, the long-term trajectory will depend on decisions made in the years prior. The U.S. could stabilize its interest burden if growth remains strong and inflation eases without triggering recession. Or it could confront a situation where the Treasury must choose between raising taxes, cutting discretionary spending, or allowing inflation to erode real debt levels. None of these choices are easy. But they are the choices every nation eventually faces when interest becomes its largest bill. For the individual citizen, the impact is not felt in congressional hearings or bond auction charts. It is felt in the cost of a home, in the monthly credit card statement, in the job openings that disappear, in the salary increase that fails to keep up with prices, in the mounting sense that stability once assumed is no longer something the system provides automatically. When the US loses its cushion, ordinary people lose theirs first. The question now is not whether the United States can navigate this transition. It is whether households can adapt faster than the system shifts beneath them. And that is why paying attention matters. Because the forces reshaping America's financial architecture do not announce themselves with alarms. They move quietly through bond auctions, budget projections, and yield curves long before they reshape your daily life. If you want to follow these shifts before they show up in your bills, your mortgage, or your investments, well, you already know what to do next. Hit subscribe before the next data release does it for you.